this video, I'm going to show you how to make $100 a day trading cryptocurrency using technical analysis, although this can be applied to any tradable asset. What I'm not about to tell you to do is to scan a bunch of news sites, follow social media accounts, or any other tricky process, putting you at the whim of some other external factor. This process keeps you 100% in control of your outcome. Welcome to the channel. My name's Michael, and thank you for joining me. This video is for education and entertainment purposes only. Past results are not indicative of future performance. Everybody must do their own research and trade and invest at their own risk. First up, we need a charting platform and an exchange or broker. I use TradingView for my charting platform, and it's completely free to set up and use. You can also get a paid version where you can upgrade to get additional features such as alerts and different indicators, but I find the free version will definitely be enough to get anybody started on the right foot. You'll also need an exchange or a broker. I use interactive brokers for the traditional markets and also SwiftX. Now, SwiftX is for Aussies and New Zealanders for spot trading, and Bybit for leverage trading, although Bybit also offers spot trading too. And I'll leave some links in the description below. There are a bunch of sign-up bonuses and perks from those links below where you can get yourself some free Bitcoin and also other deposit bonuses too, so check them out. But before we get into the nuts and bolts of making $100 per day, we'll go through a few of the fundamentals and the basics. Starting out, we'll look at the different chart types. Now, on the screen, you can see what's called a bar chart. We can also change to something like a candlestick chart or even a line chart. But what they're doing is just giving us the data for a set period of time and also just plotting that on the screen. So with the line chart, typically you can look at a line chart based on the close of each period. So if we're on a daily chart, it would be the closing price of every day, and it just plots those lines and draws obviously a line. Whereas if we're looking at something like a candlestick chart or a bar chart, it's giving us much more information because we get the opening price, the closing price, and also the high and the low price. So for a candlestick chart, if the bar is red, it means that the market opened higher and closed lower. Whereas if it's green, it means the market opened lower and closed higher. And the same is true for a bar chart as well. They give us the same information. Some people prefer candles, other people prefer bars. I prefer bars, and you can get different kind of patterns between which chart you're actually looking at. I learned on bars when I started, and that's just what I've always stuck with. It's also what the masters who've come before me use, such as Wyckoff and also W.D. Gann. So I just tend to stick to the bar chart myself. But what this is doing is just giving us that information. We can also change the different time frames. So like I said before, this is the daily chart. So every bar represents one day. Whereas if I go down to something like the 4-hour chart, we can see each bar represents 4 hours. So that's all we're doing there when we're changing this, the different time frame. Each bar is always representing whatever time frame we're actually looking at. Now, the time frame somebody chooses is going to depend on their trading style and what they're trying to achieve. Now, an intraday trader or a day trader is going to be looking at some very small time frame charts. Anything from a sub 1 minute bar to maybe a 1 hour or 4 hour bar. Whereas a swing trader is going to be looking at something like the daily chart. They want to be getting into a position and holding on potentially for a few days, maybe a week, to really ride those waves that are a little bit bigger. So they'll be sticking to a larger time frame chart. You can also add different indicators and tools to the chart, which will give you a different perspective on the market. You can see on the bottom of the screen, I currently have the volume scale selected. So this is the amount of transactions that are actually going on. So for you to add the volume to your chart, go up to the indicators section on the top of the screen. You can type in volume, and as you'll see, we can just select that basic volume looking indicator right there. Now, I already have mine on the chart, so I can just go ahead and delete one because I don't need two. What you can also use is different drawing tools. Now, I use the 50% tool and also the trend line quite a lot. So we can see the trend line here. If that's not what you see on yours, there's a little arrow on the right and you have a bunch of different tools. So I have the trend line selected and also the 50% as well. So if you don't have the 50%, it's just the fib retracement. And to set that up, you can see that I only have one line on there. I just double click it, change the settings and leave everything but nothing but 0, 0.5 and 1. That's how I get my 50% point, because it's simply just a calculator measuring from a high to a low. You can see how it adjusts no matter where the price points are. As for the trend line, that's just simply a line, and we can use it to join a couple of highs or lows. And if we want to shoot them off to the side of the screen to look at future support and resistance, we can extend the line to the right, as you can see there. So they're the two tools I'll be using in this particular tutorial, but obviously you just have to be aware that there's a bunch of other indicators, tools and techniques. So the reason someone would use different tools and techniques is just to get a different perspective on the market. It's all about using the data that we have to see if we can make it to be something a little bit more usable looking forward, because we're always trading the blank side of the screen, the unknown. This is all the known, and we're using data from the known to look forward that little bit to see if we can get some kind of insight into the blank side of the screen, or at least that's what I try and do, and we can get those odds in our favor, more often than not, especially after a bit of practice and experience. So if I was to be drawing some tools on this particular chart right now to get some kind of insight as to where we may see some support and resistance into the future, I could simply just use the 50% tool going from the highest point on the screen down to the lowest point on the screen, and also just shoot some trend lines as well off into the future to see where we may be seeing some support and also some resistance. So I'll just keep this pretty simple so we have something to work with moving forward, and we can just kind of get some support and resistance lines in the future. So we're just going to be expecting that the price may reach these lines and potentially just bounce away from them, find some resistance like it had done in the past. We had a previous top as well, and that acted as some resistance the next time the price got up to that point, just like it had done in the past as well. We had previous support and the price came down, and then we had some support once again, and the market bounced away. So that's just basically a very simple way of looking at some tools. We have our 50%, we have our trend lines, and then also just some support and resistance. Now, if you do want to shoot some support and resistance lines off into the future, we can just use something like the trend line once again, and just also shoot it from a low, and then shoot it across the screen. And we also have some underside support lines should the market fall back that low. I've jumped into my Bybit account so we can see what this looks like on an exchange as opposed to just the charting software. Now I also have Bitcoin up on the screen. And if we're thinking about that $100 per day, we know that Bitcoin can move $100 in a heartbeat. It's obviously trading at a significantly higher price than $100. So for it to bounce around for that kind of range is really unrealistic to expect those kinds of returns getting into the market and out of the market that quickly. Those moves are really reserved for the high frequency traders or the automated algorithmic bots. What I'm going to show you is something a little bit more realistic, because keeping in mind to be getting into the market and out of the market to make that $100 move on something like Bitcoin, you need to have the full amount of capital in the account to be realizing that full $100. But we're going to be going through some of the numbers very, very shortly. So up on the screen now, you can see I have a 50% level, a few trend lines, and also a support and resistance line. The 50% level is the same as what I had in the charting software, simply high down to low. Also some resistance overhead with just a straight trend line, and then also obviously the trend lines going from high down to high and then low up to low. So what I've also got marked on the chart here is just a little window of opportunity. So hypothetically speaking, if I was to buy Bitcoin as it hit that window of opportunity at $43,000 and then sold, if it got to the top of that little box, I'd have a $500 profit, assuming I had over $43,000 in my account to purchase a whole Bitcoin and then obviously sell a whole Bitcoin to realize that profit. But how about if I didn't have an entire Bitcoin's value in my account? Let's say I only had an account balance of about $5,000, roughly speaking. That means if Bitcoin hit this price of 43K, I could purchase roughly 0.1 Bitcoin, 1/10 of a Bitcoin, because I didn't have enough in the account. I had roughly 1/10, just a little bit over. I could only purchase 1/10 of a Bitcoin, which would cost me $4,300. I just simply remove the decimal place. That's all I can afford to buy. So if I'm only buying 0.1 of a Bitcoin and then I'm selling when it reaches this particular price up here, I'm not going to be making $500. I'm going to be making 1/10 of $500, because after all, I bought 1/10 of a Bitcoin. The profit is only going to be 1/10 as well. So my profit's only going to be $50. So that's the way it would look if I didn't have the full amount in my account. But obviously I want to be reaching that $100 per day. So I need to be doing something a little bit differently, maybe taking 2 of these types of trades, or maybe looking for a setup that has a bit more opportunity in it. So what you can see now in this hypothetical example is I've just opened that window of opportunity up to $44,000. So using the same $5,000 account, I'm only able to purchase approximately 0.1 of a Bitcoin, meaning I only have 0.1 of a Bitcoin. And if I was to reach that target of $44,000, instead of making $1,000, because I'm not trading a whole Bitcoin, I'm trading 1/10, I'm only going to be making $100. So in that situation, I'd be able to reach my target of making $100 per day with a $5,000 account, not using any leverage at all, simply buying and selling 0.1 of a Bitcoin. Provided there's at least a $1,000 move, I can profit that 1/10 of the move, making that $100. But how about if I only have an account of $3,000? That's where things get a little bit interesting. Now, looking at an example, when I only have a $3,000 account, I can no longer purchase 1/10 of a Bitcoin. A whole Bitcoin is $43,000. 1/10 of a Bitcoin is $4,300. Now I have this set up where I have a $1,000 window of opportunity based on the price of Bitcoin. So I want at least 1/10 of a Bitcoin to be able to profit that $100. But $3,000 is not going to get me there because I need $4,300. So this is where something like leverage comes into the equation. Provided I've done my research and I have a plan and I know what I'm risking, I'm going to have more on risk soon, I can use something like leverage so that I can use this particular setup with the account size that I have to reach my target. Trading is risky, let alone trading with leverage, so it's certainly not something I recommend to anybody, especially someone who's new to this game. Most traders do lose money because this game's tough. Now it's tough not only because it's difficult to identify profitable trading setups, but because there's also a significant mind game that's going on when we are trading. Like I said before, using leverage is incredibly risky because you can actually lose more money than is in your account. It's using borrowed money from a broker or an exchange to speculate in hope of obviously making some profits with money that you don't actually have, so you can have bigger positions. So for that reason, I don't recommend it to anyone, especially if you're new to this game. But I have been asked by a number of people to talk a bit about leverage trading and talk about what it is, how it works, that kind of thing. So that's why we're here. So the reason a broker or an exchange would lend someone money is the same reason that a bank would lend someone money to buy a house. The person doesn't have enough money, so they go to someone to borrow some money. And with the trading side of things, if you want to be borrowing or trading with more money, you have to borrow that money from somewhere, and that's where the broker or the exchange comes in. But of course, there is always a cost of doing business. They're not in it for, for good service or for goodwill. They want to be making money too, and they do that by using things like trading fees, also borrowing fees as well. You can also get yourself rebates depending which way you are using these things, but we'll just go through a few of the intricacies of how that actually works. On the fee side of things, some brokers and exchanges will just charge an outright fee per transaction. So it doesn't matter what you're doing in there. Every time you make a trade, you're buying or selling, there'll be a flat fee or either a tiered fee based on how much you're buying and selling. Other platforms will have what's called a maker fee and a taker fee. So with something like Bybit and other crypto exchanges as well, especially when you're using leverage, if you're using market orders or stop market orders, something like that, you're going to be taking liquidity out of the market because you're just getting out at the next available price. So in those situations, you're going to be getting charged a taker fee, and that's the commission side of things. That's where the broker makes their money or the exchange makes their money, and obviously the user is getting the benefit of just getting into or out of the market at that next available price. Using something like a limit order, you're actually putting liquidity into the market because you're not getting into and out of the market at whatever the price is right now. You're putting orders and creating liquidity. So the exchange is actually going to give you a rebate. You get a rebate, you get paid to put those orders into the market. And once again, you'd be using different kinds of orders based on whatever strategy is being deployed in the market. Sometimes it's worth paying that fee to, use and execute a system that you want to be using. Other times it's a different kind of system and you just have to take that into consideration as well. In addition to transactions costs, there's also borrowing costs as well because the user is borrowing money they don't actually have. Just like borrowing money for a house, you're paying the bank interest rates, you're paying them fees, that kind of thing as well. So it's no different in the markets. You have a borrowing rate that you need to pay. So in this case, you can actually see at the top of the screen the funding rate countdown. So if there's a leverage position on, being held in the market, you're going to be charged 0.01%. This is for Bitcoin every 8 hours. It will count down. It will charge your account based on this particular rate. Whereas you can also get rebates as well if you're short in the market because once again, you're providing liquidity. So it does depend what the position is in the market. That's kind of how it works. So you have your transaction costs by the maker and taker fee. You also have the funding costs, basically like a holding cost of holding the leverage position as well. That's what the funding rate is at the top. So coming back to this example of trying to make $100 off my $3,000 account, and I have a window of opportunity of about $1,000. So I need at least 1/10 of a Bitcoin because 1/10 of 1,000 is $100, and 1/10 of a Bitcoin is going to cost $4,300. So since I don't have enough in my account to purchase 0.1 of a Bitcoin, I'm going to need to use something like leverage to get that position. To check the leverage settings that I have on my account, I can go up to the top here and click this button where it says cross. Now, anybody looking to explore this further must do your own research and understand the difference between cross and isolated margin modes. In a nutshell, cross margin mode is going to risk everything that's in my account for this particular position, whereas isolated is going to risk only what I'm putting up for margin. I can also toggle between the different leverage settings. So 100 is full beast mode and 1x is no leverage at all. So I'm going to leave it to 10x leverage just for simplicity so we can go through this example and hit confirm. So as you can see, if I was to use 10x leverage to purchase this 0.1 of a Bitcoin, I'd only have to put up $430 worth of margin to take this particular trade. I've also got a note here with $3,000 in my account for this hypothetical example. If I was to use 2x leverage, I'd only have to put up half of that 0.1 of a Bitcoin, coming in at $2,150. So in that case, I could still be using my $3,000 account to take this hypothetical trade. To show you what this looks like in terms of an order ticket, on the right hand side of the screen, this hypothetical example, if I wanted to be purchasing Bitcoin at $43,000 with my $3,000 account, I already have the margin setting set to 10x. I want to be entering if the price is greater than or equal to. So I use a conditional order and a trigger price of that $43,000. Now we know I want to be purchasing 0.1 of a Bitcoin. That's what I need to profit the $100 from a $1,000 move. So in the quantity, I put it in 0.1. And now I've also got buy long with TPSL. That means take profit and stop loss. So in this example here, the take profit is $44,000. And on at the little small writing at the bottom, you can see the expected profit would be $100 USDT. Now, I always use stop losses when I'm trading with leverage. That's just a given. I think it's very dangerous to trade without them. So in this example, just for round numbers, I'll put a stop loss in at $42,000. And if this trade did actually fail, you can see the expected loss would also be $100. Now, looking at reward to risk, that's a whole nother ballgame and a whole nother story in itself. But for the purpose of this example, looking to make that $100, here's a hypothetical way of actually doing that based on the numbers. Just below the stop loss, you can see the open long with 436.12 USDT. So that's the margin requirement that the exchange needs to make this trade. And since there's $3,000 in the account, it's more than enough to make this trade. That's thanks to the 10x leverage. So that's where we can see how leverage, the power of leverage, comes to light. But of course, it is a double-edged sword and risk needs to be managed accordingly. In this video, we went back to the beginning, looked at charting software, brokers and exchanges. Then we delved into different chart types, timeframes, indicators and tools. From there, we looked at a hypothetical example and broke down from spot trading, as in using the full amount to make that $100 per day, and also using leverage as well, looking at the inner workings of leverage, different costs and fees. I hope you found this tutorial useful, and if you do want more tutorial type videos, leave me a comment below and let me know what you want to see next. Once again, thanks for tuning in to the end, and until next time, I'll catch you then.